Ladies and gentlemen, Greg Mikulowski from ForexLive.com. This is a Forex Quick Look. I'm going to take a look at the Aussie versus US dollar. It's moving out to new lows and tilting the bias a little more in the favor of the sellers. I'll tell you why and show you where it needs to go to increase that bearish bias or reverse the bearish bias and turn more bullish. So let's get started. If I sound wishy-washy, it's because the price action is wishy-washy. If we take a look at the price action last week, there's lots of ups and downs, ups and downs, ups and downs. That happens. The market's unsure of which way it wants to go, and there are some breaks and false breaks, and there's some support levels holding as well. So let's talk a little bit about what happened at the lows for the week. And this is last week's trading. The market fell down. We tested this low swing area over here. The swing area was defined by a swing high right here where the price moved lower. Then we traded a little bit above it here and failed to move to the downside, but we moved above it here and then came back to it and found support buyers here. Moved back higher and came back to it again, found support buyers again here, moved way to the upside here and came back down to it and found support buyers a couple times here before we then traded above and below it over the last few trading weeks. There were some times when the price did find resistance here, maybe a little bit here, but what we saw in trading last week was a low price right here did find support. We pushed to the upside. The upside, however, was limited. We did get above this the 200-day moving average, which is this green line right here, this flatter one right here. We also moved above the 200-bar moving average on the 4-hour chart here and here, but could not sustain momentum above either of those levels, and we started to rotate to the downside, closing below the 200-bar moving averages on Friday. And in trading this week, we've seen further moves to the downside that has taken the price away from these moving averages here. That tilts the bias more to the downside. So staying below the 200-day moving average, staying below the 200-bar moving average on the 4-hour chart. You might add the 50% retracement of the move up from this low right here to this high right here. All those levels come at this area right through here. So as long as the price can stay below those levels, the bias remains to the downside. Now we're also moving below the 100-day moving average, which is increasing the bearish bias as well. And for traders who are looking for even a closer risk defining level than up here, that 0.65466 level is going to be a risk defining level. Stay below the 100-day moving average, keeps the sellers more in control. Now on the downside, what do we have to look forward to increase the bearish bias? And you see this line right here. This line was, again, that swing area where we had support, support here, traded above and below through here. Well, obviously, that level needs to be broken on the downside, and it's joined by this blue line right here, which represents the 100-bar moving average on the 4-hour chart. Both those levels come in at 0.6524. Move below that level increases the bearish bias from a technical perspective and has the traders looking toward the 61.8% rate around the 0.6500 level. Get below that level, and it opens the door further to the downside for this pair. So sellers are making a play this week, this Monday, staying below the 200-day moving average, 200-bar moving average, 50% retracement level, and also getting below the 100-day moving average. If they can keep below these levels, sellers remain more in control with more downside work to be done. My name is Greg Mikulowski. Good fortune with your trading. Bye-bye now.